JPMorgan has expected strong central bank and investor demand to lift gold prices to $6,300.
If the market is running in the opposite direction, you're raising it to 6,500. Why? Were you being...
The bank now forecasts central bank gold purchases of about 800 tons in 2026.
Safe haven assets, treasuries, dollar, gold are not all performing in the same way, and we do think that gold is the best geopolitical hedge.
These are four of the world's largest banks: JPMorgan Chase, Barclays, Deutsche Bank, and Scotiabank, that spent nearly a decade rigging the gold market, paid over $1 billion in fines, and kept their banking licenses. This is the complete investigation into how the most important price in the world was manipulated, who did it, how they got caught, and what it means for every single person who owns, invests in, or simply trusts the gold market. Welcome to Gold Report. By the end of this video, you will understand not just what happened, but how it worked, why it was allowed to continue for so long, and what it tells us about the gold market today. On September 12, 1919, 5 men walked into the London offices of a bank called N.M. Rothschild & Sons. They sat down, made some calls, agreed on a number, and walked out. That number, $20.67 per ounce in dollar terms, became the official price of gold for that day. And that ritual, that same basic process, would be repeated every single business day for the next 96 years. This was the London gold fix, and for nearly a century, it was the most important price-setting mechanism in the entire gold market. Here is how it worked. Twice every business day, at 10:30 in the morning and again at 3 in the afternoon, London time, representatives from 5 major banks would get on a private telephone conference call. They would tell each other how many gold bars their clients wanted to buy or sell. They would propose a price. If the buyers and sellers didn't balance out, they would adjust the price up or down until the market balanced. And then the chairman declared the price fixed. That fixed price then became the benchmark for the entire global gold market. Mining companies used it to value their production. Central banks used it to value their reserves. Gold ETFs used it to price their funds. That twice daily number influenced approximately $1.2 trillion in daily gold-related transactions around the world. For 96 years, this process was run by 5 banks in a private phone call that no journalist was ever allowed to attend, that had no permanent employees overseeing it, and that operated with almost zero external regulation. The 5 banks that ran the fix were Barclays, Deutsche Bank, HSBC, the Bank of Nova Scotia, and Société Générale. Now here's the critical thing you need to understand about this arrangement. These 5 banks were not neutral referees setting a fair price on behalf of the market. They were active traders. They had their own gold positions, they had their clients' gold positions, and they were simultaneously the people setting the benchmark price. The same institutions deciding the price of gold were the same institutions profiting from gold trading. Researchers at NYU's Stern School of Business examined the data from these daily fixings and found something extraordinary. In 2010, large downward price moves happened during the afternoon gold fix 92% of the time. A separate analysis by a consulting firm called Fideres found that gold price behavior during the fixing calls suggested possible manipulation 50% of the time between January 2010 and December 2013. These were not conspiracy theories. These were statistical analyses of publicly available trading data, and they pointed to something deeply wrong at the heart of the gold market. The story of how that wrongdoing was finally exposed and prosecuted is not one story. It is 4 separate stories, 4 banks, 4 scandals, 4 sets of fines that together paint a picture of an industry that treated the gold market as its personal profit machine for nearly a decade. We begin with Barclays because the Barclays case was the first. It was the crack in the wall. June 28, 2012, a Friday afternoon in London, at exactly 3 p.m. the afternoon gold fixing session begins. 5 banks on a conference call. The process that had been running since 1919. Routine, unremarkable. Except that on this particular afternoon, yet a man named Daniel James Plunkett was watching that call very closely. Plunkett was a director on Barclays' precious metals desk. His job was to price and manage complex financial products linked to gold. And on this day, he had a very specific problem. Barclays had sold a customer a complex financial product called a digital exotic options contract. The terms were straightforward. If the gold price fixed above $1,558.96 at the 3 p.m. London fixing, Barclays would have to pay that customer $3.9 million. The gold price going into that afternoon's session was hovering right around that threshold. It could go either way. Plunkett made his decision. During the fixing session, he placed a massive sell order, between 40,000 and 60,000 ounces of gold, equivalent to between 100 and 150 standard gold bars. This was a deliberately oversized sell order designed to push the price down, to create artificial selling pressure, to keep gold below that threshold. It worked. The price fixed at exactly $1,558.50, just 46 cents below the barrier. Barclays avoided the $3.9 million payout, and Plunkett's own trading book made an additional $1.75 million. The entire manipulation took less than 10 minutes. Now here is the detail that makes this story almost unbelievable. The very next morning, Barclays' customer contacted the bank, yet having noticed that the gold price had fixed just below the threshold. When the customer's concerns were relayed to Plunkett, he said nothing about what he had done. He cited general market conditions. He gave a completely false explanation. And he continued lying to his colleagues, to the compliance department, and later directly to the Financial Conduct Authority during their investigation. But there is another layer to this story. June 28, 2012 was the day after, the very next day after, the UK Financial Conduct Authority had publicly fined Barclays for manipulating LIBOR, a separate financial benchmark. The entire bank was already under a microscope for dishonest market conduct. It had just been publicly shamed, and one of its traders on the following afternoon manipulated another benchmark. When the Financial Conduct Authority proved what had happened, they fined Barclays £26 million, roughly $43.8 million US. It was the first time in history that any bank had ever been fined for manipulating precious metals prices. Plunkett was personally fined and banned from the financial services industry for life. And when the FCA looked further, they found that Barclays had failed to put any proper controls around its participation in the London gold fix for the entire period between June 2004 and March 2013. 9 years, no adequate policies, no adequate training, no monitoring systems, no controls around conflicts of interest. 9 full years of operating in one of the world's most important markets with essentially no internal oversight. Barclays reimbursed the customer the full $3.9 million they had been owed. But the bigger question this case raised was simple and devastating. If one trader at one bank was doing this on one afternoon in 2012, what had been happening across the other 4 banks on hundreds of other afternoons over the previous decade? The next piece of the story involves Deutsche Bank, and the Deutsche Bank chapter matters not just for what the bank did, but for what it revealed about everyone else. In January 2014, Deutsche Bank announced that it was withdrawing from the London Gold Fix panel. It was the first bank to leave. The exit was quiet, but the financial world noticed. When it came just months after Bloomberg had published a major investigation reporting that UK regulators were scrutinizing the gold fixing process for potential manipulation. In 2014, a group of gold and silver futures traders filed lawsuits in the United States alleging that a group of major banks, including Deutsche Bank, HSBC, Barclays, Bank of Nova Scotia, UBS, and Societe Generale, had conspired to manipulate precious metals prices since 2007. The lawsuits alleged that these banks used their position as London Fix members to influence benchmark prices in their own favor, sharing information and coordinating pricing during the fixing calls. In December 2016, Deutsche Bank agreed to pay $60 million to settle the U.S. class action lawsuit, but the settlement contained something even more significant than the money. Deutsche Bank agreed to cooperate with the plaintiffs and to hand over evidence against the other remaining defendant banks. Chat logs, internal communications, documentation of how the coordination worked. In January 2018, the CFTC issued a separate enforcement order requiring Deutsche Bank to pay an additional $30 million penalty for manipulation, attempted manipulation, and spoofing in precious metals. And in September 2021, two Deutsche Bank precious metals traders, Cedric Chanu and James Vorley, were convicted in U.S. federal court. Deutsche Bank's cooperation and the evidence it produced pointed towards something coordinated. Multiple institutions, multiple desks, multiple countries, a pattern stretching across years. The Scotiabank story contains a lesson that goes beyond the manipulation itself. It is a lesson about what happens when a bank tries to cover up its crimes during the investigation. In 2018, U.S. regulators first caught up with Scotiabank. The bank was fined $800,000 for spoofing in gold and silver futures markets. For a major international bank, that is essentially nothing. But during the CFTC's investigation, Scotiabank made statements to regulators that turned out to be false and misleading. The bank did not fully disclose the true scale of what its traders had been doing. When investigators dug deeper and uncovered the full picture, what they found was far more serious. Between January 2008 and July 2016, 4 precious metals traders employed by Scotiabank, operating out of offices in New York, London, and Hong Kong, had been placing thousands of fake orders to manipulate gold, silver, and platinum and palladium futures markets. Thousands of episodes of unlawful trading activity, the same basic mechanism as the other banks. Place large orders with no intention of executing them, move the price, cancel the orders, profit. When the true scope of the misconduct was exposed, the CFTC went back to Scotiabank with a much larger bill, $42 million for the underlying manipulation, and then a separate record-setting $17 million penalty specifically for making false and misleading statements to regulators during the investigation. The final total was $127.4 million, announced in August 2020. The U.S. attorney on the case described it plainly. The traders had attempted to rig precious metals futures prices in their favor by placing thousands of orders they knew they would cancel before the trades were executed. Scotiabank was also required to submit to oversight by an independent compliance monitor for 3 years. Everything in this story builds toward JPMorgan, because the JPMorgan case is not just larger than the other scandals, it is in a different category entirely. JPMorgan Chase is the largest bank in the United States, and between March 2008 and August 2016, a group of traders on its precious metals desk ran what the U.S. Department of Justice described as a criminal racketeering conspiracy. The precious metals desk operated across New York, London, and Hong Kong. Over those 8 years, traders placed hundreds of thousands of fake orders in gold, silver, platinum, and palladium futures markets, place large orders, create false signals of supply or demand, move the price, cancel the orders, profit. But the scale at JPMorgan was unlike anything the other cases had revealed. Hundreds of thousands of fake orders, 15 traders involved, 8 years of continuous operation. The heads of both the precious metals desk and a parallel U.S. Treasuries desk were implicated. The losses inflicted on other market participants, the investors, funds, and institutions on the other side of these manipulated trades, exceeded $300 million. In September 2020, JPMorgan admitted wrongdoing and agreed to pay $920 million. It was the largest fine in the history of the Commodity Futures Trading Commission, the largest spoofing fine ever imposed anywhere in the world. $436.4 million in criminal penalty, $311.7 million in victim compensation, $172 million in disgorgement of profits. 3 separate U.S. agencies acted simultaneously: the Department of Justice, the CFTC, and the Securities and Exchange Commission. Now let's talk about the people at the center of this. Michael Nowak was the head of JPMorgan's global precious metals trading business. He ran the desk that federal prosecutors described as a criminal enterprise. He was indicted in 2019, charged alongside 2 other traders, pleaded not guilty, and went to trial. In August 2023, a federal judge sentenced Michael Nowak to 1 year and 1 day in federal prison, 2 years of supervised release, and ordered him to pay a $35,000 fine. And Greg Smith was a gold trader on that same desk. A federal prosecutor described him at sentencing as, quoting directly, "the most prolific spoofer that the government has prosecuted to date." He was sentenced to 2 years in federal prison, 2 years of supervised release, and ordered to pay a $50,000 fine. During the investigation, it emerged that traders openly discussed their illegal activities in chat messages. One trader wrote on 6 separate occasions that he was spoofing the market, using the exact word. Another described manipulating high-frequency trading algorithms as a little razzle-dazzle to juke the algos. And the CFTC noted in its order that during the early stages of the investigation, JPMorgan responded to certain information requests in a manner that resulted in investigators being misled. The bank, more like Scotiabank, initially did not fully cooperate. JPMorgan's agreement with prosecutors ran for 3 years, expiring in September 2023. In March 2024, the Department of Justice confirmed that JPMorgan had fully met its obligations. The case was closed. The bank kept its license. It continued operating. Now let's put the full picture together. JPMorgan paid $920 million. Scotiabank paid $127.4 million. Deutsche Bank paid a combined $90 million. Barclays paid approximately $43.8 million US dollars. Total documented fines across these 4 banks. Over $1 billion, $180 million. Verified, court documented, admitted to. These are not allegations. These are settlements and convictions where the banks either admitted wrongdoing or were found guilty at trial. And the losses to other market participants were documented at over $300 million in the JPMorgan case alone. The full economic impact of nearly a decade of manipulation across multiple banks in the world's most important gold pricing mechanism cannot be precisely calculated. But consider what was being manipulated. The London gold fix influenced approximately $1.2 trillion in daily gold-related transactions globally. Every mining company, every central bank, every pension fund, every ETF investor, every person who ever bought a gold coin was pricing their gold against a benchmark that was being manipulated by the very banks running it. There was no separation between the referees and the players. They were the same people. In 2015, the London gold fix in its original form was replaced. Instead of 5 banks on a private phone call with no oversight, the new LBMA gold price system uses an electronic auction platform. Instead of 5 members, it involves 15 or more accredited institutions. Every order, every price movement, every participant action is electronically recorded and auditable. Whether that is enough to prevent future manipulation, regulators and investors continue to debate. What is not debatable is that the old system failed, spectacularly. The evidence of that failure is documented in court filings, regulatory orders, and prison sentences. For anyone who holds gold or is considering it, here is the conclusion that matters. The manipulation proven in these cases was primarily a form of short-term price distortion. Spoofing affects intraday price movements, and the statistical research that was conducted on the fixing data suggests that gold prices during that period were being pushed down, not up. The banks were using their position to suppress the gold price in the short term, on specific trading days, for their own benefit. The gold price today is determined through the electronic LBMA system with broader participation and full audit trails. The individuals who ran the schemes have been convicted, the institutions have paid over $1 billion in fines, and gold, after all of it, is trading above $4,400 per ounce in 2026. JPMorgan, the same bank, fined $920 million for manipulating it. Moy is now projecting gold to reach $5,000 per ounce by the end of this year. Let's go back to where we started, September 12th, 1919. 5 men in a room in London. They agreed on a number, and for 96 years, the global gold market trusted that number. That trust was not always warranted. We now know with documented certainty that the institutions running that process placed their own profits above the integrity of the market. They placed hundreds of thousands of fake orders. They moved prices to avoid paying their own customers. They lied to investigators when they were caught. And across 4 major banks, they paid over $1 billion to settle the consequences. Michael Nowak, the head of JPMorgan's global precious metals trading business, is in federal prison. Greg Smith, described in federal court as the most prolific spoofer the U.S. government has ever prosecuted, is in federal prison. Scotiabank tried to conceal the full scale of its misconduct and paid a $17 million penalty specifically for lying to regulators. Barclays manipulated the gold fix in a 10-minute phone call to avoid paying a customer, the day after being publicly fined for manipulating a different benchmark. The fix was fixed. That is now a matter of legal record, but gold survived it. The asset itself was not diminished by the dishonesty of the people pricing it. If anything, the proven suppression of gold prices during a decade of manipulation may partly explain why gold has moved so dramatically since those controls were removed. The scandals in this video are not a reason to distrust gold. They are a reason to understand it, to know how it is priced, who prices it, and what the history of that pricing process tells us about where we are today. The London gold fix ran for 96 years. For at least part of that time, multiple banks were manipulating it. That has been proven in court, prosecuted, and fined. And gold, through all of it, is still the asset that every major central bank in the world is still buying. That is the complete investigation. This is Gold Report. Subscribe for weekly gold news, price analysis, and investigations every week.